Hello everyone. Welcome to the August 2024 edition of the Idaho Department of Labor's Labor Market Insights series. My name is Lindsay Trombley, and I'm the Public Information Specialist at the Idaho Department of Labor and your host today. Today we have labor economist Sam Wolkenhauer here to present on the housing market and examine trends in construction activity, interest rates, and the rental market. So with that, I'm going to give Sam the floor and let him start.
Good morning. Thanks for being here. What we're going to do today is dedicate our whole hour to the housing market, which is obviously a major point of interest for a lot of people. We understand that there are maybe some asymmetries and some issues with affordability. And so when we give these economic updates, unfortunately, we have to squeeze housing in alongside a lot of other important topics. And so today we want to give housing the full look, give it all the time, and try to understand holistically what's going on in the housing market. And so, sort of capturing the essence of the problem. There's a consumer sentiment study, a survey done by the University of Michigan, where they look at people's attitudes about the economy, what they think of the economy. And right now, the percentage of people who say that it's a good time to buy a home is essentially at an all-time record low. You know, so the vast majority of people, something on the order of 90% say it's a bad time to buy a house right now. And so that kind of captures the overall pessimism around the market. And we want to understand why, right? What's going on with the market? And we understand that this is a complex interplay of issues, right? It has to do with trends in construction, mortgage rates, inventories and availability. We also understand that the rental market is kind of its own distinct market that has its own dynamics. And so we just kind of want to get a holistic sense of what's going on in the housing market. So hopefully we'll be able to do that in the coming hour. So we want to start by just getting a sort of snapshot of what's going on with the market. We want to understand the structure of the housing market. What are the broad trends with construction, financing, mortgage rates? And then we also want to address this sort of looming elephant in the room. Uh, we know that something went disastrously wrong in the housing market in 2007. And we understand that that came on the heel of a rapid run-up in prices. And we've had a similarly rapid run-up in prices in recent years. And so we want to ask this sort of million-dollar question: please tell me that it's different than 2007. Please tell me that we're not standing at another precipice. So we want to understand structurally why the housing market is looking very different than it was in 2007, notwithstanding that rapid increase in prices. Okay, so we're just going to kind of jump right in with a snapshot of the housing market, a look at housing affordability. And one of my favorite measures for looking at this is something that we call the Case-Shiller Home Price Index. This is a broad look at home prices. And one of the things that's distinct about it is they look at repeat sales of homes, right? So they try to adjust for the age, the quality, the size of homes being sold to look at the core of what's going on in the market. Okay, and so you can see a rapid run up in prices. And so the way this index is structured is the number 100 corresponds to the year 2000. So when you see that the index is at about 325, that means that prices have increased essentially 325% since the year 2000. So homes are more than 3 times as expensive as they were a couple decades ago, right? And when COVID hit and we had this big increase in mortgage rates and there was all this uncertainty in the economy, there was a big fear that housing was going to correct, that prices were going to come down, there was going to be some sort of crash. Well, you can see the quote unquote crash here. If you look very carefully, right, it's very small. There's a tiny dip there right around the year 2020, 2021, that lasted for a few months and then it bounced right back and continued its rise. And so this concern really didn't end up materializing. We didn't have a big drawdown in prices. Indeed, they've kind of continued their run up towards the top right corner. So we have a picture of a market that has been sort of steadily, inexorably running up for years on end, right? And this captures something that we all know, that home prices are at record highs. They don't show any sign of abating. And this is creating stresses on American buyers and on American households. So the picture of the housing market is essentially this line running up towards the top right corner, and it would seem indeed that there's nothing able to stop it. So this is our sort of backdrop, a massive increase in prices, record low affordability, and that's reflected in the fact that pretty much all American households understand it's a very difficult time to buy a home. And so this is the phenomenon that we want to understand. Another thing that I think might be useful is to contextualize this compared to past decades, prior decades. So uh, this graph shows you the increase in home prices by decade, right? And the black line is the decade that we're currently in. And you can see that not only have we had pretty consistent increase in prices over time, but so far in the 2020s, even with the COVID recession, even with interest rates increasing, price appreciation is actually running ahead of the decade of the 2000s, which was obviously the decade that we had the housing crash in. So far, prices have increased 48% already since 2020. Okay. And so already on the heels of many decades of increasing prices, this so far has been the fastest increase yet in the 2020s. So we understand that not only are prices increasing in the long run, but they would seem to be accelerating, right? Since this is the fastest decade so far. And we obviously would like to understand this. Now, I'd like to briefly take a slight digression and talk about how housing relates to inflation overall, right? Inflation is obviously a major topic. We're kind of slowly beginning to climb down from several years of high inflation. American households are certainly feeling the strain of higher prices. So we would like to understand how housing relates to the bigger topic of inflation. Okay, because this is actually quite important because this is the basis for what happens to interest rates. So what I'd like to show you is that the housing component of the price index, okay, which is the black line, the housing component was slower to increase than the rest of the inflation index, which is the blue line. Okay, so all item inflation began to run up in 2021 and 22. Housing didn't begin to peak until 2023. Okay, so housing as a component of inflation was a bit of a lagging metric. And part of the problem here, what we want to emphasize is that housing is not always perfectly reflected in the inflation indicators. And I'll explain why that is. Okay, so the general measure of inflation is what we call the CPI, right? Which is just a measure of prices that of goods that people consume. Well, here's the problem with housing. From the perspective of the CPI, your house is not a product that you consume, quote unquote. We want to emphasize that word consume. And the reason for that is because you can sell it, right? So if you go to the grocery store and you buy a loaf of bread or you put gas in your car, right? Presumably those things are gone in a fairly short amount of time. Even something a little more durable like a television or a car, eventually, right, you consume the product and it sort of dissipates as an economic entity. Well, you can buy your house and 30 years later, the house is not consumed, right? You still have it and you can sell it. And often you can sell it for a lot more than you purchased it for. So what that means is that when we're thinking about consumption, things that people buy, houses are more of an asset than they are a consumption item, right? So that means that it doesn't necessarily fit in the CPI with other products, but we still understand that people spend a lot of their income on their housing. So what the Bureau of Labor Statistics does with housing when they try to figure out prices is they go, well, we're not so much interested in the price of your house because that's an asset. It's not a product that you consume. So instead, we want to know what would you have to pay yourself in rent if you were to rent the house, right? So when you look at housing in the CPI, home prices are not so much important. What's more important is rents, okay? Because rent, unlike a home that you purchase, is consumed, right? You don't accumulate an asset for that rent. So for that reason, housing can be a little bit tricky in terms of how it fits into the larger CPI. The other thing that's important to understand is that interest rates, your mortgage payments are not reflected in the CPI. So all of that to say, the burden of housing expenses can sometimes be a little bit understated in the CPI simply because of the way that it's calculated. However, at this point, housing is now one of the major factors driving inflation. You can see that by mid 2023, housing inflation was running pretty well ahead of the rest of the CPI. So at this point, housing and the burden of higher rents, higher mortgages, et cetera, are going to be one of the major burdens on households as the rest of the inflation indicator has come down. So all of that to say, sort of long story short, housing was a little bit slower to materialize in the inflation indicators, but now by 2024, that expense has become one of the major burdens on households. Okay. And so obviously a major component of this is interest rates. So let's take a little peek at interest rates. There are two interest rates that are really important here that we want to think about. So obviously we want to think about mortgage rates. Okay, so that's your black line, the 30-year sort of benchmark mortgage rate. And then we also have this thing called the federal funds rate. So you're maybe going to get a little bit more of a peek at monetary policy than most people care about, but I think that this is important for understanding how the housing market works. There's a misconception that some people have that the Federal Reserve, our central bank, that they set mortgage rates. They actually don't. What the Federal Reserve does is they set an interest rate for lending between banks, right? Because banks lend to each other, they borrow from the Federal Reserve, and this sort of forms the bedrock of financial transactions. And so that rate that banks lend to each other, the overnight interbank lending number, is called the federal funds rate. And so that's the blue line. And it essentially forms the sort of the baseline interest rate on which other interest rates are calculated. A sort of allegory would be the idea of oil prices and how oil prices affect the price of most things in the economy, right? We understand that gasoline, fuel are sort of a core input that goes into everything else, right? So when gas prices rise, price of everything else rises. The federal funds rate is kind of like that. It sort of lies at the bottom of the financial system. So when that moves around, it affects everything else. And you can see the big run up in the federal funds rate and in mortgage rates after COVID. So after decades of declining mortgage rates, right, you can see this goes all the way back to 1992, year I was born, right? So for most of my life, I've lived in a declining rate environment where this line was slowly winding its way down towards the bottom right. But then COVID comes along, we get inflation, and the Federal Reserve has to rapidly increase interest rates, and this runs up the mortgage rate. Okay, so here's the big story. When mortgage rates began to rise, it creates this problem of unwinding the mortgage market because people have been borrowing at really low rates for decades at this point. So the question becomes, how is the mortgage market going to react to this sudden run up in rates? It's the first real run up in over a decade. So how's the mortgage market going to react? And the answer, it turned out to be, was that the market really reacted by doing nothing at all. Okay, so let me show you what I mean. That black line is the rate for new mortgages, right? So interest rates rise, new mortgages run up from, people were getting sub 3% rates in early 2020. And all of a sudden, a new mortgage is going to cost you 6.5%, 7%. Well, what did people do? They just chose not to move. So the blue line shows you the outstanding mortgage rate. So that's all the people that are out there locked into those nice low rates. This really did not come up at all. Okay, so you can see the blue line continued to hover down there at that nice, cozy 4% number. What ended up happening was, in response to the run up in new rates, people just stayed in their homes. Why on earth would I move? Why would I abandon my nice 3.8, something on that order, to take on a new mortgage at 7%? That kind of would be the height of financial lunacy. So I'm not going to move. I'm going to sit where I'm at. I'm going to sit on my nice cozy 4%, and I'm just going to wait for rates to come down. So what ended up happening is the run up in mortgage rates, instead of causing the mortgage market to unwind, that would be our term for people start borrowing at the higher rates, these lines kind of come back together. Instead, it just locked people into their existing mortgages, locked them into their houses, and stopped them from moving. So the net effect of this, the effect of running up the mortgage rates was essentially that mobility in America dropped to all-time lows. And we can measure that by just the percentage of people that moved. And last year, the percentage of American households that moved to a new zip code, new state, was at an all-time low. So nobody was moving, and the effect of that is to keep a lot of housing inventory locked off of the market. Okay, so what happened was rather unexpected. You might think, okay, mortgage rates are going up. It's going to make borrowing more expensive. That's going to create a burden on a lot of American households. They're going to have to buy homes at these really inflated high prices. They're going to have these high rates. People are really going to be struggling under the financial burden of purchasing housing. Didn't happen. Instead, all it did was it kind of froze the market in place. Okay, so very few people are moving, means very few people are selling their homes. So there's really not much to buy. There's not many people moving. We're all just kind of sitting here frozen in place, waiting for this thing to unthaw. Okay, and this is a big reason why prices are stuck at these high levels, right? We have a lot of inventory that's frozen off the market because people just cannot afford to give up their mortgages. And there was actually a recent study by some economists at the University of California, Berkeley, who estimated that probably something like 700,000 Americans who would have moved decided not to simply because of the mortgage rate differential. Now, the important thing to understand is this has major impacts on the labor market. So I want you to think about what the labor market was like in 2021. Okay. In 2021, labor mobility was very, very high. Okay. And this was because telework was huge, right? COVID kind of provoked a short-term revolution in telework. You had a lot of jobs being offered where people could work from another state. Okay, so this kind of creates a record level of labor mobility where you could be living in Idaho, working for a company in Seattle or California or vice versa. Okay, fast forward it to today. Telework has fallen out of style. Companies have increasingly decided that more of a hybrid work arrangement is what they like to see. So you have less telework, and people can't afford to move because of the high mortgage rate, that mortgage rate differential. So we've had a significant decrease in labor mobility in a very short period of time. You go from 2021, which is sort of this wild west of all-out telework, to 2024, where telework is really evaporating quickly, and people can't afford to physically move because of the interest rate differential. So one of the impacts of the housing market and the structure of the mortgage market that we've seen is that labor mobility, the ability of people to move to find new jobs, has decreased significantly. Okay. And you do see this partially reflected in the fact that fewer people are quitting their jobs. You see fewer people job hopping, shopping, testing the market compared to a couple years ago. So the housing market has definitely contributed to a decrease in labor mobility. And this mortgage rate differential has essentially frozen people, and it has frozen the housing market in place. And the result has been low inventory, very little housing available to buy, which means high prices. And this has particularly been a problem in Idaho. So I'd like to give you a look at Idaho's market compared to the rest of the country. This is the median listing price, right? So, average home, 50th percentile. You can see this big run up in Idaho. There is a seasonal factor to it, right? Based on the season, prices do kind of ebb and flow, but the trend is clearly towards the upper right. So the median listing price in Idaho at this point is well over $500,000. Okay, and this has made homes increasingly unaffordable for many, many people. Okay. Now, what I want you to note, though, is that Idaho has a higher median listing price than the rest of the country. And that's particularly problematic because incomes in Idaho are actually a little below the national average, right? So that would make our houses even more unaffordable, relatively speaking. So when we contextualize this against incomes, right? So this is the price to income ratio. You take the median listing price and you compare it to the median household income. Long run, if you go back to the 1980s, 90s, 70s, sort of the latter portion of the last century, on average, median house was about 2.7 times the median household income. And so economists had kind of developed this as a rule of thumb, right? An affordable home should be somewhere around 3 times median income. But in Idaho, our price to income ratio is over 7 to 1, right? And for a brief period of time in the middle of the pandemic, it was over 8 to 1, right? So when you contextualize our abnormally high home prices against incomes in the state, housing is clearly unaffordable in Idaho for many, many households. And so we can come to this very firm conclusion that housing affordability and housing availability are really at record lows in Idaho. Okay. And that is made even more so by the high interest rate, right? Because if you want to buy a home, unless you can pay cash, not only are you entering the market at a record price, but you are also accepting an unusually high mortgage rate relative to what people were paying just 3 to 4 years ago. So kind of our summary of market conditions here. Affordability unequivocally is at record lows. And this is reflected not only in the sort of basic measurements of the home price index or listing prices, but it's exacerbated by the structure of the mortgage market. Secondly, we need to understand that the structure of the mortgage market is suppressing America's mobility, right? It is less affordable to move now than it has been in a long time, and this is reflected in a record low percentage of Americans moving state to state. And we have to understand that housing is at this point one of the major drivers of inflation, of what's left of the inflation that's lingering, and it is a major burden on households. Okay, so that can seem somewhat less than cheery, we will acknowledge. So let's try to understand kind of the structure of the market. Okay, so fundamentally, housing supply can come from two places, right? It can come from someone selling an existing home, or it can come from the construction of a new home, right? So we've already seen that existing home availability is low because people don't want to move. They don't want to give up their low mortgage rates to accept a higher rate. So existing home inventories are low. Well, what about new homes, right? We should probably take a look at construction activity. And there has been an increase in construction activity in Idaho. This is residential building permits. And you can see that it has increased pretty steadily over the last decade, right? But what we want to understand about this is that this increase reflects Idaho trying to dig its way out of a deficit. So let's think about the big housing crash, the financial crisis in 2007 was coming on the heels of a really hot market. Prices had increased significantly. There was a lot of building activity. Suddenly, the sky falls, the roof caves in, and the market collapses. Well, what happened? Well, building activity collapsed to multi-decade lows. And this put Idaho in the hole, essentially, because we now had really low building activity right around the time that Idaho's population was about to explode, right? So we know that Idaho's population has increased substantially throughout the 2010s. It continues to grow. Idaho has been one of the fastest growing states in the country essentially every year for the last decade. We're always right at the top of population growth metrics. And yet, when that population boom started, we were really in this pit of building activity. So if you look at it in terms of the population level, right? What this graph is showing you is building permits per 10,000 residents. Okay, so it's sort of like new homes on a per capita basis. You can see that the entire 2010s, we were well below the previous decade. Okay, so look back at that graph. We were building somewhere between 6 and 8 homes, per 10,000 residents all through the 90s, the early 2000s. Suddenly that collapses down to about two, right? So it's almost a quarter of what it was. And it took us a whole decade to build our way and try to build up some steam to get out of that deficit. So we essentially had an entire decade, the 2010s, where we were underbuilding relative to the size of the population and the scope of the population growth that we had. We were finally building back up to, sort of pre-crash levels, and then COVID came along and we lost some of those gains. We're now building our way back out. But what I really am trying to emphasize here is that we really have hits on both sides of the housing supply. Okay, so existing home sales are low because people don't want to give up their mortgage rates. Everybody's frozen into their homes, sitting on those 4% rates. They don't want to move. So existing home availability is low, but we also had a decade of sort of underbuilding relative to the population level, which meant that the supply of new homes coming online was less than what it had been in prior decades. And part of the problem here was that we really had a massive layoff in construction that took us a long time to build out of. So if you look at construction employment in Idaho, okay, look at that big drop starting in 2007. That makes sense, right? Financial crisis, housing crash, builders get hit really hard, and there are massive layoffs in construction. But I think that not a lot of people are aware that it really took us the entire decade of the 2010s to recover from that, right? So it wasn't until 2021 that we finally reached the construction employment that we had in 2007, okay? So you're talking about essentially a 14-year decline in construction employment relative to pre-crash levels. So to put it another way, if this graph was what the total employment looked like, right? If you had a big recession and it took you 14 years to recover from it, you would call that a depression, most likely. But because it was confined just to the construction industry, it really didn't get noticed in this way. But this reflects the fact that we just were not building as many houses as we were before the big financial crisis. And this all results in a constrained supply of housing. Now, I want to pivot a little bit, and I do want to talk about kind of the plus side of high home prices, right? So when you talk about prices being at all-time highs, that obviously has a negative connotation in the sense that it makes it hard for people to buy homes. The flip side of that, however, is that presumably someone owns that home and they own that home at a record high price, which means for their finances, that's a good thing, right? So the plus side of all of this is that American real estate wealth is at an all-time high, very obviously. That really doesn't need any elaboration. When you have this massive increase in prices, it's really a boon to existing homeowners. So right now, American households own something like $45 trillion in real estate assets. Okay, so that's very significant. Uh, but we kind of want to ask the question, okay, who owns those homes? Okay. And this is not to drive any sort of intergenerational resentment. This is obviously going to be very important for reasons I'll explain momentarily. So we have $45 trillion in real estate wealth owned by Americans. And let's ask who owns that on an age basis. So if you cut it up here, the green slice is the slice of the wealth owned by people under the age of 40. Okay, and the blue is everybody 40 and older. Now, one thing that we have definitely seen over time is that the share owned by people under 40 is declining. Okay, so in 1990, people under the age of 40 owned a little under a quarter of all the real estate. Okay, now we understand naturally that it is older Americans who will own more of the real estate wealth. That just goes without saying. This is not to drive any kind of intergenerational resentment or competition. When you're older, you have more wealth accumulation, you have more equity. So that's natural, right? But in 1990, younger Americans owned a little under a quarter of the real estate wealth. That share has declined to about 12% today. Okay. And that does reflect the fact that millennials have been slower to buy homes. It's been harder for them to find entry-level housing. Okay, so millennials are definitely behind on home ownership compared to prior generations. Now, what's very interesting, however, is that if we look a little more closely here, we find out that a lot of the real estate is owned by senior citizens and the oldest Americans. So let me show you what that looks like. If you overlay people over the age of 70, you see that there's been a significant increase in real estate ownership among the oldest Americans. So again, in 1990, people 70 and older owned about 27% of the real estate. Now, what I want to highlight is, remember, 1990, under 40 was at 22%. Okay, so that was actually pretty close, right? 70 and older and 40 and under were pretty close in terms of the amount of equity that they held. Today, people 70 and older own over a third of the real estate. Now, why is that important? Well, that is housing that is expected to be transferred one way or another in the coming decades. Okay. Just looking at the actuarial tables from the Social Security Administration, people over the age of 70 are expected to transfer their housing to someone else at some point in the next 2 decades. Now, that can look a variety of different ways. They could bequeath it to their descendants, to younger members of their family. They could sell it to pay for assisted living. But from an economic perspective, that's essentially the same thing, right? Because it's housing that becomes available and passes on to someone else. Okay. So we need to understand over a third of all the real estate in the United States is potentially going to change hands in the coming decades. Okay, so that is the point of looking at this age cut of the real estate equity, is we need to understand there is an unusually large wave of housing that is likely to be transferred and to exchange hands in one way or another in the coming decades. Okay, so this could potentially be a source of relief in the housing market long term if all of that housing begins to change hands. Okay. So one other thing that I want to look at here that's very, very important is to look at the rental market, okay? Because the rental market and the purchasing market are related, but it's not always clear how they're related. So I want to look at that. So let's kind of shift here and look at rents, and then we'll talk about how rents are related to home prices. Okay, so we do need to understand right off the bat, Idaho renters are pretty significantly cost burdened by rising rents. So the Census Bureau looks at rents and they compare that to household incomes, and we have a definition of being rent burdened. So essentially, if you pay over 30% of your income in rent, you are cost burdened. And if it's more than 35%, you are considered highly cost burdened. So if you look at the large counties of Idaho where we have good data on rents, you can see that nearly 50%, and in some cases more than 50% of renting households are considered cost burdened. Okay, so a significant share of Idaho households that are renting find that their rents are a pretty significant burden on their ability to meet expenses. Okay. Now, one thing that we want to note, though, is that there actually seems to be some relief coming in the rental market. So I want to show you what that looks like. So this is a comparison of home prices and rents. Ordinarily, you would expect home prices and rents to track pretty close to each other. And that's because those things are kind of perfect substitutes in a lot of ways. Right? If it's significantly cheaper to rent than to buy a home, what are people going to do? Well, they're going to rent. The other thing is that rents and home prices compete in many cases from the same supply, right? So a house can just as easily be purchased and used as a rental as it can be purchased to use for a primary residence, right? So we understand that rents and home prices, new home prices, should track very close to each other because these are substitutes in a lot of ways. But one of the interesting things is that we're seeing a big divergence in rents and home prices. So what we've seen since 2020 is that home prices have increased significantly faster than rents have. And actually, this is now the largest gap between rents and home prices that we have seen since, you guessed it, 2007, when we had the big financial crisis. So the question becomes, what's going on here? Why are rents and home prices diverging? Why aren't they moving in unison like we would expect them to? Because you can see that from 2012 to roughly 2020, these were tracking pretty similar. Okay, so why the sudden divergence? What's going on here? Well, the answer seems to be that we've actually had a surge in new rental units coming online in the market, and that's provided a lot of relief for renters. So this graph charts projects under construction. Okay, so this isn't new projects, this isn't starts, it's not permits. This is projects currently under construction. Okay, and blue is single family, and then the black line is multifamily. And what you notice is that multifamily projects really built up over the last 5 to 6 years. So you ended up having a sort of surge of incomplete but almost complete multifamily projects. Okay, so another way to think about this is you kind of had like a backlog of multifamily construction projects that were not completed, they were nearing completion, and then those have suddenly started to come onto the market. So we've had sort of like a supply surge of multifamily housing. And it came from all these incomplete projects that were being worked on and had built up. And then that backlog gets released onto the market. And so what you end up having is a surge in multifamily units available. Okay. So that's been a really nice relief for renters. And that is the main reason why rents and prices have diverged. Okay. Because you had a sort of glut of multifamily units coming onto the market, providing relief. Okay. Now the sort of dour note here that we want to note is that it looks like this is a one-time surge in supply, because if you look at starts, right? So that last graph was projects in construction. But if you look at new projects being started, there isn't an elevated level of multifamily projects. Okay. So if we think about this rationally, okay, you don't have a big surge in new projects, new multifamily projects, but you have a lot of multifamily projects in construction. What that reflects is a sort of backlog of projects being completed. Okay. And so once those are all completed, that supply surge is going to slow down. But for the time being, we do have a nice surge of multifamily units coming onto the market. That's providing some relief for renters. And that is the main reason why, a single family home price, but rents are diverging. Okay. So there is some relief for renters has been really nice to see. And then in Idaho, we similarly see more single family housing under construction than multifamily. Okay. So if we're to kind of look back at our big opening question, right? We know that housing's very unaffordable right now. People cannot afford to move. There's a lot of anxiety in a sense that this is not a good time to buy a home. Okay. So how is this different from 2006 and 2007 when prices were also very high? There was also a divergence between prices and rents. And we know how that ended. That ended with a major financial crisis, massive foreclosures, and a contagion that created a pretty widespread recession in the US economy. So, how is this different, right? Well, the big difference is that right now, the constraint is largely on the supply side. Okay. The problem is that we're trying to dig our way out of a decade of chronic underbuilding at the same time that people are locked into their homes by this mortgage rate differential. So right now we have record low inventories. There's very little available to buy, and the market is just kind of frozen in place. Okay. That's very, very different from in 2006, 2007, when you actually had very high buying activity. Okay. The market was very frenetic. It had a lot of kinetic energy that was driving prices up. Today, we have a supply constraint. We have a supply crunch. And the problem is almost the exact opposite right now. So in 2006, you had a lot of people who were taking on unaffordable mortgages. Today, what you have is people who are choosing not to move because their mortgages are actually quite affordable. They're locked into mortgages that they took out years ago with these nice, cozy 4% rates, and they don't want to move. Okay, so in essence, the market is once you look past the veneer of high prices, the market is sort of the literal opposite of what you had in 2007. In 2007, you had a market with a lot of kinetic energy, a lot of purchasing, a lot of risky lending activity. It was a very high volume, aggressive, moving market. Today, you have a market that's frozen. And it's frozen because people do not want to move and they do not want to accept the interest rate differential. So, although the veneer, the sort of surface level look at prices can look scary, those prices are high for a very, very different reason. And so we think that the problem is actually quite different. The problem is not a high kinetic energy market with a lot of volume and a lot of risky lending activity. The problem is a low volume market that's essentially frozen in place. So when we look at the big picture, we have to acknowledge that affordability is at record lows. Okay. We have not only had a massive increase in prices and higher interest rates, but we also need to understand that this isn't necessarily captured in the inflation metrics. And the net effect of that has been to lock people into their existing mortgages and freeze people off the market. We also need to understand that supply is low because it's being hit from both sides. Remember, not only are existing homes frozen off the market by the interest rate differential, but new home supply has been held down by a decade of chronic underbuilding. Okay, and so we're trying to slog our way out of a supply crunch that's being created from both sides. But again, there's not all dour news, right? Because when prices are high, that also means that the value of those assets is high, and that's good for people that own real estate, that have existing mortgages at low rates, and own prices that are own homes that are very, very valuable right now. We do see some relief coming, particularly in the rental market. And this comes in the form of that backlog of projects that we saw. There's a lot of units under construction that are finally being completed. And so that's providing some relief in the rental market. And finally, we want to understand that the structure of the American real estate market in terms of who owns the homes is very different than it was several decades ago. In 1990, the amount of real estate owned by young Americans and people over the age of 70 was quite similar, right? It was a fairly balanced market. Today, you have low ownership among young Americans, very, very high ownership among the oldest Americans. And that means that there's a significant amount of American real estate, of American housing that is going to change hands in the coming decades. Okay. And that also represents a form of relief on the supply side. So, big picture right now is a market that's unaffordable. Yes, there's very little available to buy, but the structure is very different than it was in 2007. Rather than being driven by high volume and aggressive lending behavior, it's really frozen in place by that mortgage differential. But we do see some relief coming in the form of more completions that are in the pipeline in the rental market. And finally, we want to understand that in the long run, there is a lot of real estate that is going to change hands, that's going to transfer hands in the coming decades due to the age structure of who owns that housing. So that is obviously not going to be any sort of immediate relief to people that are struggling to find things to buy or who are unable to move to take a job. But the sort of silver lining here is that this is a very different market than we saw in 2007. And so the nature of the concern is different. So for now, we're frozen in place at the top, but we do see those sources of relief coming. And with that, I think we will open it up to questions that I think Lindsay is going to manage on her end.
Yeah, so it does look like we have a few questions that came in. And as a reminder, everyone, if you do have a question, you're more than welcome to pop it in the Q&A below, and we will get Sam to answer it. So there is a question in here. Um, it's asking, is there any information on single family homes being purchased by investors? Do you know if you have any of that data?
Um, we don't have firm data on investment purchases versus purchasing to purchasing to use as a primary residence. We can look, the Census Bureau does collect some data in the American Community Survey on whether housing units are owner occupied or not. And there has been a slight decline in that, but not a huge decline in owner occupation.
Now, there's another question that kind of goes in hand with that in a way, so it might be a similar answer, but it's just asking, when you say Americans, how does this data differentiate from a US citizen buying a house versus outside international investments?
So we do have pretty significant international investment in the American real estate market, simply because that's viewed as an extremely safe store of value. Um, I will say that, for example, when I was showing you the real estate wealth, that those are the financial accounts from the Federal Reserve, and that's looking at American citizens. So that's looking at private American households. So that 45 trillion number, that's Americans, right? Because that's household wealth. That's not institutional holdings or investments. So that is specific to that is specific to American households.
Now, we do kind of have a question when you were talking about the rental market. Um, the information that you're sharing about the rental market, does that also include elderly housing for senior living?
So rents, the rent series that I was showing, is from I believe that's from the National Housing Finance Agency. I can look at the technical notes on the data. I don't know if that includes senior living facilities. I would have to look at the footnote on the data to give you an answer on that.
Okay, no worries. This is kind of an interesting question. Someone's, saying what goes up must come down. Any indications about when to expect the next crash? Kind of talking about referring to 2007.
We I don't see anything in the market that suggests a repeat of 2007 is likely. Um, Part of that is that people have not been taking out a lot of mortgages at these elevated rates. Most people are still sitting on the lower rates that they took out over the preceding decade, which means that most people actually have relatively affordable mortgages right now, right? So the threat of lots of people defaulting would seem to be much lower, because people are still sitting on these rates that are down between 3.5% and 4%. So the idea that lots of people are going to begin defaulting on their mortgages does not, it really doesn't seem substantiated, because they've not been dumping those lower rates. They're sitting on them.
Okay. Um, so we do have a question about construction employment. They're just kind of asking, should we be targeting that 2007 level, where the state's more likely like oversaturated during that time because of the housing demand, or should we be looking at kind of 2003 levels?
Well, you would think that construction employment would be significantly higher than 2003 levels, because the state's population has grown substantially since then. right? Idaho has added hundreds of thousands of residents since 2003. So just looking at a pure numerical basis, you would expect it to be much higher, just because our economy is significantly larger.
Okay. Let's see. Um, we do have another question. Um, I don't know if you'd be able to answer this, but can you speak to the size of single-family homes that are currently being constructed? Is the scarcity of a starter home of modest size contributing to the high medium home prices?
So there is some evidence that the size of new starts is beginning to come down. Um, for a long time, the structure of the market encouraged larger and more expensive homes because there's been a shortage of construction labor, right? So builders have a limited capacity to bring houses online. So a lot of builders are going to prefer more expensive, higher cap projects. There is some evidence, though, that the median size of new starts is beginning to come down due to that demand for starter homes. So we might be seeing kind of a reversal on that front.
Um, we got lots of questions coming in, so that's awesome, you guys. Another question, if interest rates decrease and more homes go on the market, do you expect prices to decrease significantly? Are you able to kind of touch on that?
It's unlikely that interest rates are going to come down fast enough to make an immediate impact, right? Because they're talking about maybe a decrease of 0.25%, possibly 0.5 in the federal funds rate. I think mortgage rates would probably have to come down to 5% or lower before you see people really ready to begin moving and venturing away from their existing mortgages. So I don't think that the short-term rate decreases are going to create a big impact.
Um, okay. So there was some things that you were talking in there that I actually found really interesting, and I'm sure some attendees did as well, is you were kind of talking about, the huge number of the population is kind of older and that they're going to have, some turnover in housing. And this question is kind of in relevance to that. So they're asking, if a third of residences might be transferred, and decades later, do you know if that will bring down the prices of homes?
I can't speak to the scale of a decrease in home prices over time. That would be very speculative, but what we can definitively say is that in the long run, I think that the supply crunch is going to be eased considerably in some areas by the amount of homes that begin to be offloaded by older Americans. So we are looking at a sort of unprecedented exchange of ownership due to aging. And that will create relief in the supply of houses.
Okay. Now, I actually had a question myself. So I know you said that, people aren't really moving in the state because they don't want to kind of give up their mortgage. How does like people moving into Idaho affect this? Like, are they just kind of filling in the gaps, or is this just more of like people moving into state? Is that just more of a reason for more housing to be developed?
Well, a lot of the people moving into Idaho are older because older Americans are less likely to need to finance because they can sell an existing home and pay either all or mostly cash. Particularly if they're moving, and if you look at where people are moving into Idaho from, a lot of it is from California, which is a very, very expensive market. So they can take advantage of the discrepancy in home prices. So mobility overall is down because people don't want to abandon their cheap mortgages. But there's going to be certain pockets of the population that still have mobility. And the classic example of that would be someone who's retired and can sell a home in California and then pay cash for a home in Idaho. right? So overall mobility down, but there's certain pockets of the population that are not affected by that.
Okay, that's super interesting. Um, so there's another question in the chat. It's asking about rental units. So they're asking if rental units coming like on the market. Is the state creating more backlog since there aren't many new projects starting?
Yeah, so that rental chart of new units coming online, that was national. What I would say is that's why I was trying to emphasize that it's sort of like a one-time surge of supply because the starts aren't increasing. It's like a backlog of projects that are being completed. But if you look at new projects, those are pretty flat. So it is a one-time sort of shot in the arm in terms of a lot of new multifamily units coming onto the market. So it's not like a big shift in the way the market's going to look, but I think it's still going to be very helpful to have that surge of supply.
Mhm. Okay.
But that doesn't preclude long-term another shortage from arising, essentially.